What's up, everybody? Welcome to the fair value gap video of the J&J Futures Bootcamp. This is another extremely key concept in the world of technical analysis and ICT and with our strategy. So let's just get right into the fair value gaps.
What is a fair value gap exactly? Once again, it's another form of liquidity and it's called an imbalance. Basically, where price rapidly moves up and orders get left behind. So these imbalances in the market are areas where we know price is going to go back into because we need to fill the orders that are left behind when we're rapidly moving up or rapidly moving back down. Yep.
Yeah, these fair value gaps can be very important because they can act as magnets for price to return to, and then how price reacts with them is also very crucial. There is also a big difference between bullish and bearish fair value gaps. So if you look at the screen here, these three green candles are a bullish fair value gap, and the three red candles are a bearish fair value gap. And how this forms is the top wick of the first candle in a left to right three candle pattern and the bottom wick of the third candle are not overlapping. There is a big gap, a fair value gap in between those candles. And then the opposite goes for a bearish. The first candle bottom wick or skinny part right here is not overlapping with the top part of that third candle.
So like Jack said, we need these areas of liquidity or these little gaps to actually form a fair value gap. So we can see on this other graph right here, the left side, these candle wicks create this little gap or also a box. And on the right side, we have the wicks that are covering the body of the middle candle and there's no box formed. So when these wicks wick down into the candle that's in the middle or the second candle, there's no gap that's formed. This would not be a fair value gap right here.
Another big concept, like I said, is how we interact with the fair value gaps. And one way that we can interact is by respecting it, it's called, which is where price goes into this gap that we created and then it goes back after respecting the gap that we created. So, an example would be, let's say a farmer goes to a town and a bunch of people really, really want bananas from the farmer. So many bananas that the farmer does not even have enough that he can sell. So he goes over to a farm nearby and gets a bunch of bananas, and then he comes back to give the people in the town their bananas. That would be an example of respecting a fair value gap because price is going back into that town, filling all those orders, that imbalance, and then going back on its way.
So now that we've got the farmer example out of the way, let's show you what one of these respects actually looks like. So we'll look on the chart right here. I drew out a fair value gap, a bullish fair value gap on the 5-minute chart. So we can see there's a candle right here and a candle right here, and we create this gap in the middle. So the wicks come up, the wick came up here, and the wick came down here. There's a gap. So price is moving, chop, 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 whatever it does, it goes up. Then it comes back down in this little wick right here called respect. It touches the fair value gap. It fills the orders in this gap. And then prices goes back on its way. So it touches here, keeps moving up. And this happens all the time in the market. This is how markets work. This is why they move, and this is why they move up and down. They chop, they go whatever which way. This is why. Fair value gaps.
Also, with fair value gaps, they can really be powerful on any time frame, but the higher the time frame, the more effective they can be for predicting the direction of the stock market. For example, on Jake's chart, he's got the 4 hour right now, and he can draw this box here, this fair value gap. And as you can see, we come back just like the farmer with the bananas, and we respect the 4 hour fair value gap. And then, since these are 4 hour candles, that means the next few days we're all bullish or going upwards after respecting a bullish candle or a bullish fair value gap. And the same exact thing would happen with a bearish fair value gap. If we made a bearish fair value gap and then came and respected that, then it is a good chance that price is going to be going down for the next few hours or even days. Higher time frame fair value gap respects are definitely better for overall direction for the market, like we just said, and then lower time frames like the 1, 2, 3, 5 minute are what Jake and I will use for our entries in order to get nice trades going, which we will touch on later in the boot camp.
So just a live example. This is the 4-hour time frame, like Jack said, and we're on the Nasdaq. So this is up to date. Today is December 30th, 2024, and we see a 4-hour, a huge bearish fair value gap right here. Huge. We see the candles come back in. They touch into the gap. These are where orders are being filled. So over the course of this week and a half, orders are being filled. If we respect it, we come all the way back down and we're back out of the fair value gap. So for the next day or two, we expect price to keep going down.
Yep, so to conclude, those are fair value gaps, aka imbalances, and they are another form of liquidity, which we just touched on in the last video of the bootcamp. So if you haven't watched that, make sure to check that out. And that is day 2 of technical analysis here at the J&J Bootcamp. Make sure to check out the next video where we'll dive even deeper into different forms of fair value gaps.